Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. The question I'm sure all of you have, the Fed did not cut rates, so what did the Fed do for there to be such kind of a risk asset rally? Euro higher, stocks higher, gold made a fresh all-time high. So lots of things happening over there. Morning, JK, take our listeners through the FOMC debrief and your takeaways from the meeting.
Good morning, Swaraj. Actually, Fed has marked to market all the parameters as per what the market was expecting, and unchanged projection for cuts in 2024. Three cuts, start date not clear. Higher rate projection for next 2 years, that is indicating confidence in growth. Higher GDP projection than that was seen in December. PC headline inflation maintained at 2.4%, that is closer to 2%, and increased core maintaining current pace of balance sheet reduction, but will slow in the coming months. All these look like they're just meeting the market expectations. Powell's language in his presser also did not contain any surprises. Keen to meet 2% inflation target. Inflation still remains elevated. Risk to employment and inflation moving to better balance. But my key takeaways. See, his assertion that rates will not go back to earlier low levels indicates expectation that we are in a new regime of inflation. He indicated seasonal factors at play in higher CPI and PCI numbers in January, which might have guided maintaining the current projection for rate cuts. Significant weakening in labor market would be reason to begin rate cuts. So he is preparing a ground for starting the rate cuts the moment we see more weakness in the unemployment data. Definitely last month's unemployment number, despite the headline being higher, other parameters were actually weaker. And finally, sticking to three rate cuts actually shows that Fed is not expecting 2% inflation rate to be cut. Maybe even at 2.5%, they will be okay to cut the rate and support the economy to maintain its growth. Of course, he was non-committal on timing of the first rate cut, though he said the June was still live. Okay, so the rate cut prospects as per market discounting has gone up suddenly to 80% in June, and just about 50% was seen yesterday. Markets have celebrated, obviously, with rate cut projections maintained, rallying strongly. Yields on 2-year dropped by 8 basis points, while 10-year and 30-year were more or less at the same level. Once again, term premium increasing, which also indicates that future growth is better. Stocks rallied strongly, 1% gain for Dow and Nasdaq, while S&P gained 0.85. Asian markets have followed these cues by rallying. Nikkei hit a new all-time high once again. Now currencies have rallied along with gold. Euro again found strong support at 108.40, even as Zero business sentiment came very strong, adding to series of positive data from euro area. Seeing it pushing towards I see it pushing towards 1.10 in the coming sessions. Also, what we cannot ignore is the forward-looking indicator, that's the euro area consumer confidence, which is also improved. Now, GBP dovetailed euro with the broader dollar weakness permeating, despite UK inflation coming again lower than expected, and rate cut projections being brought forward from earlier September. Dollar's weakness is no more apparent than in the yen, which has gained nearly 1% after a third failure at 151.90 yesterday. Obviously, lower yields in US have also played its part, but significantly, what I was expecting to happen yesterday happened today. Japanese Finance Minister Suzuki said he's closely watching FX moves with a high sense of urgency. Now, what is evolving in the recent times is also that the US exceptionalism that we have been talking about, the superior growth picture of US. Now, slowly we are seeing other economies also improving. For example, today, Australian employment numbers were quite strong. Unemployment rate fell from 4% to 3.7%, and the actual employment also rose much stronger. We have been seeing good data from UK. Eurozone has shown a lot of improvement in many of the numbers. Of course, we will have the PMI numbers today, which will give a better indication on services and manufacturing. So all in all, it's a good setup for currencies to strengthen based on their economies improving, rather than just the dollar economy, UK-US economy weakening. So that is the change that I am seeing. And gold rally to new high. It's not surprising because it's a reiteration that Fed's next move is going to be cut, and that cut can be as much as 3%. And who knows, if the economy weakens more, we might see even more. That is very too early to say. But gold bulls are encouraged by the fact that rates are going to go down, yields will be lower. Therefore, it's a time to load up on more gold positions. Now, coming to our market, even as the most global markets sat on their hands waiting for Fed decision, INR charted its own path, weakening to 2-month lows, huge dollar demand dominating and helping break resistance at 83.05 and 83.10 with ease. What we have seen is a strong buying from PSU banks reportedly for oil as well as debt repayments. See, we have been talking about year-end related inflows, but we've also seen year-end related outflows in the last few days. That could have been one factor behind the dollar's strength against the INR. PSU banks obviously have been covering for all these outflows. Other importers also hedging due to year-end, and also some stop loss being on a break of 83.05. Now, in an atmosphere of strong domestic and external macros for India, the market was not prepared for the weakness seen in INR, so which we believe is not happening without the blessing of central bank, who kept away from selling dollars. The persistent rise in crude cash dollar shortage as most inflows got absorbed by RBI, and weak sentiment in equities have also added to the pressure on the rupee. What's the outlook? I think, despite exceeding our expectation of being contained below 83.0510, current move is temporary and is likely to attract fresh sellers, both exporters and FIs, and any attempt to weaken the rupee beyond 83.20 will definitely meet with RBI intervention. For the rest of the month, we should see recovery in INR, particularly after the fresh weakness seen in the dollar index, with Fed continuing with rate cut projections. In a broad picture, of course, 80 to 60, 80 to 30 will continue to hold. Thank you.
Thank you, JK, for that crisp coverage. Fed decision was as per market expectations. There was unchanged projection for rate cuts. Still, 3 rate cuts being indicated by the Fed dot plot. There was higher GDP projection than December. So that was some key highlights of the Fed meeting. Powell's speech also did not surprise the markets, and we had some rally in currencies, especially due to positive data from the Eurozone, along with Fed meeting triggering a broad dollar weakness. That has led to some strength in Euro, GBP, and of course Yen. Rupee weakened to 2-month lows due to huge dollar demand, and it broke the 83.10 resistance. But as JK mentioned, it may be short term, and we may again once again move into some recovery for the rupee. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.